where does the money go? Have you ever wondered this? When the stock market crashes, news headlines say trillions of dollars evaporated. But does money really disappear? Does it move to someone else's account? Or does it simply vanish? Understanding this one question explains why the rich get richer during recessions and why the poor fall even further behind. So today, we're going to follow exactly where money flows during a recession and why your money might be quietly leaking away right now. 1. Money was never real in the first place. Most people believe money is something solid, a number in your bank account, a stock price, your home value. But here's the truth. Money is just a measurement. Value is belief. Price is an agreement. When that belief collapses, prices collapse. This is why markets can lose trillions overnight. Not because the cash left the planet, but because our collective belief shifted. 2. The Nvidia shock. A perfect example. In January 2025, Nvidia lost $589 billion in market value in a single day after concerns about DeepSeek, a Chinese AI model. Nobody stole that money. It wasn't transferred. It simply reflected one thing. Yesterday, people believed Nvidia was worth X. Today, they believed it was worth less. And then, within days, the price rebounded because the belief shifted back. This is how recessions start. Value collapses when belief collapses. 3. When belief breaks, the bottom deck falls. First, imagine the economy as a ship with 7 floors. During a recession, people on the lowest deck fall off first. People who live paycheck to paycheck. People with no assets. People whose value is tied only to a single job. When companies panic and cut costs, these are the first to be laid off. The wealthy, they experience a temporary portfolio dip, but their lifestyle never changes. 4. The velocity of money suddenly freezes. In a healthy economy, $1 changes hands 5 to 7 times per year. During a recession, that number drops to around 1.5. People stop spending. Companies stop hiring. Investors stop taking risks. And when money stops moving, the entire economy grinds to a halt. This slowdown is what makes recessions dangerous. Not missing money, just frozen money. 5. The first destination, safe parking, savings and bonds. During recessions, money flows into savings accounts, government bonds, money market funds. They feel safe, but there's a hidden danger: inflation. If your savings account pays 0.4 to 4%, while inflation is 3.6%, your money is shrinking in purchasing power even though the number stays the same. This happened after 2020 and again in 2025. People thought they were protecting their money, but inflation quietly damaged their wealth. 6. The second destination, bargain buyers. When markets crash, millions panic and sell at a loss. But where does that money go? To the people buying at those lower prices. Financially stable young professionals. Investors with cash. People who understand market cycles. If you buy a stock at $60 that someone panic sold at $60 after buying it at $100, their loss becomes your gain when the price eventually recovers. Money doesn't disappear. It just moves from fearful hands to prepared hands. 7. The third destination, safe hard assets. When belief in currency weakens, money flows into things that feel real. Gold, farmland, art, commodities. Gold surged during the 2008 crisis. Farmland averaged 12% annual returns for 20 years. High-end art soared even during recessions. These assets don't rely on belief as much as stocks do. They are protection, not growth. 8. The fourth destination. Discounted big assets recessions create forced sellers. Landlords who can't pay mortgages, companies running out of cash, startups collapsing, distressed real estate, and who buys them? Apple, Amazon, Berkshire Hathaway, private equity firms, sovereign wealth funds, ultra-rich individuals. Why? Because they have cash. And recessions give them discounts. Every recession becomes a shopping season for the powerful. 9. The final destination. The capital gravity zone. This is where money ultimately settles. Multi-generational wealth. Families who own companies, industries, and nations. They don't measure wealth in income. They measure it in ownership, influence, long-term control. Every recession pulls wealth upward, from the bottom decks to the middle class, to investors, to corporations, and ultimately toward this gravity zone. 10. The real lesson: recessions don't change the rules of money. They only reveal who understands them. Money doesn't disappear. It flows from fearful people to confident people, from unprepared people to prepared people, from spenders to savers, from savers to investors, and from short-term thinkers to long-term owners. The question is, which deck of the ship are you on? And which direction is your money flowing right now? If you watch this far, you've already started preparing. Keep going.